run into Christmas is getting a bit shorter, but from an investment point of view, there are some big events to come before the festive break, notably the latest monetary policy announcements from the Federal Reserve on the 14th of December and the Bank of England on the 15th. No doubt policymakers will be scanning financial markets and economic data for clues, even if what they're really trying to do is set policy now for what works best in 18 to 24 months' time. But in the coming week, at least, there will be plenty of those clues as to the health of the US economy in particular. Tangible data will come particularly in the form of the latest batch of jobs figures. Watch out for the independent ADP jobs report on the 30th, the US Bureau for Labour Statistics Job Openings and Labour Turnover Survey, or JOLTS, also on the 30th, the Challenger Gray and Christmas Monthly Job Cuts Survey on the 1st of December, and then the big triple-headed dataset from the Bureau for Labour Statistics in the form of the non-farm payrolls numbers on Friday the 2nd. The headlines here to study are the number of jobs created in October, which was 261,000 in September, the headline US unemployment rate, which is still a lowly 3.7%, and then, finally, wage growth. In October, the average US hourly salary rose 4.7% year on year to $32.58. Now, that rate of growth did represent a bit of a cooling relative to the 5% plus run rate that workers had been accustomed to earlier in the year. In sum, from all of those numbers, if job vacancies keep falling, unemployment starts rising, and wage growth keeps cooling, then the Fed could find itself with scope to start slowing its pace of interest rate increases and even pause or pivot on policy and halt rate hikes and even start cutting. That's actually what financial markets are looking for and hoping for anyway, as cheap money generally keeps asset prices buoyant and more costly money tends to weigh on them. Weight stops trains, higher interest rates tend to stop share prices. Back home, there's a long slate of scheduled corporate news announcements, although none of them are due from FTSE 100 firms. Mid and small cap stocks will therefore dominate, and names which may be worthy of further attention and research include the following, although some of these dates could still be subject to change. Brickability on Monday the 28th of November, Topps Tiles, EasyJet, Marston's and GB Group on the 29th, when 888 and Wood Group will also host analyst meetings, Pennon, Hornby, Future and Mulberry on the 30th, Marlowe on Thursday the 1st of December, and Ceres Power will close out the week on Friday the 2nd. But the company which could just cause the biggest fuss in the week ahead is Shaftesbury. The Real Estate Investment Trust, or REIT, is scheduled to release its full year results for the 12 months to the end of September on Tuesday the 29th of November. The FTSE 250 firm owns a portfolio of real estate assets in London's West End that includes plum parts of Chinatown, Soho, Carnaby, Covent Garden and Fitzrovia. The shares, however, well, they're pretty much, although they're off their lows for the year, they're trading no higher now than they did in 2006, despite that prime portfolio, thanks to worries over the lasting impact of COVID on tourism, competition from online rivals for physical shops, and whether working from home will reduce long-term demand for office space in the wake of the pandemic. Higher interest rates don't help much either, as the REIT has debt, and increased bond yields usually mean property yields have to rise to compete, which means prices fall, and the equity yields have to rise to compete, which usually means share prices fall. It's unlikely that Chief Executive Brian Bickle will have answers to all of those questions, but he did his best to be bullish in early November's trading update. Mr. Bickle flagged improved footfall in the West End, fresh lettings, a drop in vacancies, and the purchase of a leasehold and also 2 buildings in Soho. However, the chief exec did also acknowledge a drop in the value of the wholly owned property portfolio in the second half of the year, which undid some of the increase seen in the first. And the first number that analysts and shareholders will dive to is the net asset value, or NAV per share figure. A year ago, that was 619p, and at the end of the first half, it was 679p, but a small fresh drop is on the cards now. After that, analysts will turn to the dividend. Shaftesbury paid 6.4 pence a share last year. The REIT has already declared an unchanged interim payment of 2.4 pence, but analysts are looking for an uplift in the second half. It will then be time to dig a little deeper into the numbers and see what's going on behind the headlines. Key figures to watch will include rental income and any sign of an increase in late payment. The collection rate was a pretty good 95% in the first half. Rental income last year was £105 million, although that was the lowest number since 2016. Look out for any comment on renewals and whether Shaftesbury has been able to increase rents in this inflationary environment. Next up, look at vacancy rates. Now, they peaked at nearly 12% during the pandemic, but have since rattled back to 4.7%. And then finally, please do look at the balance sheet. The loan-to-value ratio is not particularly high at 23% as of the end of the first half, but if asset values start to drop, then that could be a little bit deceptive as the ratio could start to rise. Net debt was at £756 million at the end of the first half. Finally, watch out for any comment on the opening of the Elizabeth line on the tube, as that could help footfall, and also the £3.6 billion all-share merger with fellow REIT Capital and Counties, or CAPCO. The deal is due to go through in early 2023, pending regulatory approval. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.